Money and mindset, the timeless principles of wealth. What if I told you that the greatest barrier to building wealth has nothing to do with money? It's not your salary, it's not the market. It's not even the economy. It's the 6 inches between your ears. For the next 10 minutes, we're going to talk about money and mindset. We're going to uncover the principles that have built fortunes for centuries, understand why we behave so strangely around money, and learn from some of history's greatest financial minds. Let's start with a story. It's 1963. Warren Buffett, not yet the Oracle of Omaha, takes over a struggling textile company called Berkshire Hathaway. It's a terrible business, but Buffett doesn't see a textile company. He sees an engine, a machine to generate cash flow. He starts using that cash flow to buy things that have real intrinsic value. Insurance companies, newspapers, a little-known soda company called Coca-Cola. His mindset wasn't, how do I save this failing business? It was, how do I allocate capital most efficiently? That shift in perspective, from consumer to owner, from spender to investor, is the first timeless principle. Principle 1. Money is a tool, not a reward. Its purpose is not to be spent, but to be put to work. This leads us directly to human behavior. Why is this so hard for us? We are not wired for modern finance. For millennia, we lived in a world of immediate scarcity. Eat the berry now because it might not be there later. This is why we have such a powerful preference for immediate gratification. $1 today feels more valuable than $1 tomorrow. This is the enemy of investing. The second behavior, social proof. For our ancestors, fitting in was a survival mechanism. If the tribe ran, you ran. In the modern world, this manifests as buying the new iPhone because everyone has it, or pouring money into a meme stock because of the frenzy on social media. We fear being left out more than we fear losing money. Let's talk about the third principle from another giant, Benjamin Franklin. Long before he was a founding father, he was a prolific printer and entrepreneur. His philosophy was simple: an investment in knowledge pays the best interest. We think investing is about picking stocks. It's not. The first and most important investment you will ever make is an investment in yourself, in your skills, your knowledge, your understanding. Your own earning potential is the most valuable asset you will ever have. This self-investment builds what we can call internal capital, the confidence and wisdom to make good decisions. Which brings us to the fourth principle, perhaps the most important one: risk management. The legendary investor Ray Dalio says, "The biggest mistake investors make is to believe that what happened in the recent past is likely to persist." We think a market that's been going up will keep going up forever, and a market that's crashing will never recover. We are terrible at predicting the future. So the greats don't predict, they prepare. They embrace the timeless lesson from the ancient Stoics. Focus on what you can control. You can't control the stock market. You can't control the economy. You can't control whether you get a surprise bill. But you can control your savings rate, your spending habits, your debt, your continuous learning, your emotional reaction to a crashing or soaring market. This is the foundation. Before any sophisticated investment, you must build your financial moat. Live below your means. Save relentlessly. Avoid toxic debt. This isn't glamorous, but it is the bedrock of all wealth. Finally, we have to talk about time. Not timing the market, but time in the market. There's a story about Warren Buffett and his longtime business partner, Charlie Munger. Someone once asked Munger what the secret to their success was. He thought for a moment and said, "We're rational people." That's it. It sounds too simple. Money multiplies over time, but only if you give it time. A mindset of patience is a superpower in a world obsessed with speed. So let's bring this home. What is the wealth mindset? It is the shift from being a passive consumer of your financial life to an active owner. It is understanding that 1. Money is a tool for building security and freedom. Your behavior is your greatest asset or your biggest liability. 3. Your knowledge is your best investment. 4. Managing risk is more important than seeking reward. Time is the silent partner of every great fortune. Wealth isn't about a number in a bank account. It's about the peace of mind that comes from knowing you have options, that you are resilient, that you are not a slave to your next paycheck or the whims of the market. It starts not with $1, but with a decision. The decision to change your mind. Thank you. Oh, we're not done yet. There is more to this mindset. The core message is that wealth is a byproduct of behavior, and behavior is driven by mindset. Let's break down each principle with practical examples. Principle 1. Money is a tool, not a reward. The mindset. Shift from seeing money as something to be consumed, a reward for hard work, to seeing it as something to be deployed, a tool for building more. The scenario: imagine two people, Alex and Sam, both get a $5,000 year-end bonus. Alex, consumer mindset, sees this as found money. They immediately think, I deserve a new TV, a nicer vacation, and a fancy dinner. The money is spent within a month, providing temporary pleasure but leaving no lasting value. Sam, owner mindset, sees this as new capital. They ask, how can I put this $5,000 to work? They might decide to use $3,000 to purchase a share of a low-cost index fund, buying a tiny piece of hundreds of companies. Use the $500 to pay down high-interest credit card debt, which is a guaranteed return on investment equal to the interest rate. Use $500 to take an online course to improve their skills and increase their future earning potential. The outcome: in 5 years, Alex has memories of a vacation and a TV that's obsolete. Sam has an investment that has historically grown, is free of debilitating debt, and earns more money due to new skills. Sam used the tool to build more tools. Principle 2: understand your behavioral biases, immediate gratification, and social proof. The mindset: acknowledge that your brain's wiring is your biggest financial adversary. Pause before acting on impulse. The scenario: the frenzy of the next big thing. And everyone at work is talking about a new hot cryptocurrency or stock. It's skyrocketing. Your friend says, I made 50% in 2 weeks. You're missing out. This is social proof in action. The urge to buy is powerful because you fear regret. Immediate gratification. I want those gains now. Principle 3: your best investment is in yourself, Benjamin Franklin. The mindset: view yourself as your most valuable asset. Your ability to earn is the engine that fuels all other investments. The scenario: Jamie has $2,000 and wants to improve their financial future. Option A, direct investment. Put the $2,000 into the stock market. With a historical average return of 7 to 10%, this could grow to about $4,000 in 10 years. Option B, invest in self. Use the $2,000 to get a certification in project management, data analysis, or copywriting. This new skill leads to a $5,000 raise the following year. The outcome: that $5,000 raise, even if they never get another raise, is worth $50,000 in pre-tax income over the next decade, far outpacing the returns from option A. Furthermore, that higher salary becomes the new baseline for all future raises and bonuses. The return on investing in yourself is often immeasurably higher. Principle 4: manage risk, don't avoid it. Ray Dalio and the Stoics. The mindset: risk is inevitable. Wealth is built not by avoiding risk, but by understanding and managing it. The scenario: the safe savings account versus the risky stock market. Many people keep all their long-term savings in a safe bank account, fearing the volatility of the stock market. But they ignore a far greater risk: inflation risk. If your savings earn 1% interest but inflation is 3%, you are guaranteed to lose 2% of your purchasing power every year. Your money is safe but becoming worthless quietly. The wealth mindset response: you manage risk by diversification. Don't put all your eggs in one basket. You spread your investments across different asset classes: stocks, bonds, real estate, and within them, different companies, sectors, countries. An emergency fund, your personal moat. You keep 3 to 6 months of expenses in that safe savings account. This is not an investment, it's insurance. It ensures that when an unexpected car repair or job loss happens, and it will, you don't have to sell your long-term investments at a loss to cover it. The outcome: you accept the short-term volatility of the stock market in exchange for its long-term growth potential, which is the only reliable way to outpace inflation. You sleep well at night because your emergency fund protects you from life's surprises. The ultimate goal: freedom. Wealth mindset is not about scrimping, depriving yourself, or becoming a miser. It's about making conscious choices that align with your long-term goals. It's the ability to provide opportunities for your family. It's the peace of mind that comes from knowing you are the author of your financial destiny, not a victim of your impulses or circumstances. Start today. Control what you can control: your savings rate, your spending, your education, and most importantly, your mindset.